Imagine if there was a cycle that could predict every time you should sell and every time you should buy to maximize profits when it comes to real estate. According to this cycle, we may be entering the final stages of the highest price growth we can experience. If you're interested in what my thoughts are and everything I talk about when it comes to the 18.6 year cycle, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now, what I am referring to is the 18.6 year land cycle. I've made numerous videos over the last couple of years on this topic, and you should definitely go check it out. My latest one is here. It's probably going to give you a before and after effect of what's actually playing out. According to a lot of people, we've entered the winner's curse, which is often the last stage before we have this absolute catastrophe when it comes to property prices. But this is all based on land prices in the US. So is this going to apply in Australia? Well, let's understand where we were to where we are about to go. What we have is this beautiful graph, and it's actually by a friend of mine, being Jason Pizzinos. And I know you're watching, so what's up? This is on the work that's been done by Phil Anderson and Akhil Patel. And just quickly going through this, there is suggestion that we actually might be at the winner's curse. And you can see the line is quite steep compared to the growth we've already experienced. But is this actually where we are? Now in 2020, we should see a mid-cycle slowdown. Now we experienced this probably earlier than 2020. We saw tighter lending conditions in 2017, 2018, 2019 was a pretty soft market for property. And then we obviously had 2020, which in the first half of the year was all met with fear, given we didn't know what was going to happen. And then towards the back end of the year, we actually had prices go up. And then in 2021, 22, 23, 24, 25, we've just seen up only. Now we do have this slowdown here. If it was to play out, the only thing I could appropriate this with is we had slowdown in Sydney and Melbourne, but that was again just for 1 year. So are we just now trying to fit our narrative? I think so. If you looked at the entire market across Australia, we saw absolutely amazing growth across areas like Western Australia in Perth specifically, and then you had outer regional areas, and Queensland is not slowing down or hasn't been slowing down. So although we had this V-shaped recovery, it was probably more looking like up only from there rather than a decline. Now what we have is the final 2 years. And again, these are averages. So before you go out and say, oh, well, okay, that means we're gonna head into a recession because Ravi shared this graph and other people smarter than Ravi also agree, I think you need to take things into context. So this last 2 years is when you see the most explosive growth. That would mean, according to this cycle, that the growth we've experienced in the last 5 years is gonna be nothing compared to the growth we experience in the next 2 years, which means some areas that have grown by 20 or 30% are expected to grow by more than that, which would be 30 or 40% in the next 2 years. I just don't see that playing out. Now, although I'm very optimistic on the market, especially for the next 2 to 5 years, I don't think we can simply go out and say, well, because this graph says the winner's curse means prices go up exponentially, we're gonna see that across all markets. Now, I do think we may experience that in markets like Sydney and Melbourne. More specifically, something like Melbourne, which has really been a poor performer over the last 5 years. In fact, there was a study that came out with the real estate group, and Angus Moore, the economist there, suggested that if prices were to continue in terms of the trajectory over the last 5 years for the next 5 years, you could see massive growth in areas like Adelaide, Brisbane, even Sydney. But Melbourne would be just lackluster. So in order for this graph to be appropriated to say something like Melbourne, it could play out really well. But if it's only grown by 17%, which is what the study had suggested, then just going up by say 30% over the next 2 years may look like a really good opportunity, but it could also mean that fundamentally we're just getting into these markets because they were affordable. Now, according to that, this would play out perfectly, with the winter cycle being the most exponential part. But I don't think it plays out for most of Australia because I just don't simply see a market going up by 40% when it's already gone up by say 50% over the last 5 years. Now here's the caveat to this entire thing, because what people are focusing on is not the winner's curse, they're focusing on what the decline looks like. It's almost as if we go, okay, well, because we've had so much growth, we need prices to pull back. But there are a couple of data points that I'm going to share with you that may not actually agree with this. And most importantly, when it comes to real estate and you were to look back at any other cycle, even if you picked the tippy top market in 2008, 2009, when you had the GFC, even if you picked the top of the market this time around, I'm almost certain that in 20 years from now, as the currency debases itself, your property would be worth more relative to the debt that you took out 20 years before that. If you think about it with Sydney, I know a lot of people purchased property in the 1990s and they purchased in 2007, 2008, and everyone had peak fear at that time. It was like the recession we had to have, and then we had the GFC. everyone was scared. And then you get told all these massive headlines, property prices are going to fall. Same thing happened in 2020, and the market did the opposite. But even if you did buy at the top, as long as you had the right strategy, you were able to hold that property for as long as possible. Now, most people, say 20 years ago, were not just investing in property, they were just buying their own place. And usually when times are tough, you will sell everything, you will stop going and having Uber Eats, you will stop going to the cinemas, but you will never let go of your house. And that's why so many people kept their house and are now thankful to themselves. So could we see a similar thing play out? Well, it's quite possible, because back then the supply and demand ratios were a lot more reasonable. Right now, we're focusing a lot of conversations around how unaffordable it is, the multiple on how much I have to make versus how much prices of property are worth. I think the bigger number to focus on is how undersupplied we are across the entire market. On Tuesday, the ABS released dwelling approvals data for March, which recorded an 8.8% monthly fall to 15,220. House approvals fell by 4.5% in March, while unit and apartment approvals fell by 15.1%. Now, this is a very telling graph here. This is building approvals, and here is the federal government's target. We've only been able to hit it once, and that was around 2012 to 2013. But since then, we've only been going down. We did have a small spike during the lockdowns, but that was the home builder package that stimulated that market. Since then, we've had construction companies go into insolvency, and I've got a deep dive video about the supply crisis I really need you to check out. I'm gonna put that video up here, and you should bookmark it and watch it after this, because it is very deep in terms of how big the problems are. And here's an updated graph of the dwelling construction versus population change. What you want is this to be the average in terms of the green line, and then what you'll have is swings up and down when it comes to approvals and commencements of new property. And that was to be true up until about 2006, and you could go on to argue until 2014 it was relatively okay. We had obviously a period of low supply here, higher population growth, and then we had supply kick in. And obviously during this period, we had prices go up, but then during this period, we did have prices slow down. Then the market got really volatile. We had population fall off the cliff because we had the lockdowns, and then we had a recovery in terms of the immigration, but since then we've never been able to recover when it comes to housing supply. So supply is one factor, and a very important factor. The other side is demand. And right now we're in a rate cutting cycle. So if we were to see the factors play out for a winner's curse, yeah, it's all playing out, because we've got interest rates about to cut, we've got easier lending conditions, which means more availability of credit. People can take that money, go into property, and they'll buy a property. We're already seeing M2 money supply across the entire world increase, and that's only going to add to this entire narrative that your dollar is losing value, and we probably see another influx of inflation in the next 24 to 36 months. But until then, we've got prices going higher in terms of property already, and we've only seen 25 basis point cuts. NAB is coming out and saying maybe we're going to get 150 basis point cuts. Now, I've explained in previous videos that if we see a 1% change, so that's 100 basis points, your borrowing capacity could increase by between 15 and 25%. That is absolutely absurd. So if you just simply said that was the formula, that the growth of property prices will be equal to how much you'll be able to borrow, if you see an increase in your borrowing capacity by say 15%, and that was the formula, then that would mean property prices would also increase by 15%. But I think it's got a multiply effect, because not only are people being able to borrow, but there are also people out there that could always borrow, but they were just waiting for the market to change. And what they were doing, and I know this for a fact because we speak to clients every single day, is that people have been sitting on the sidelines thinking that maybe the headlines are right. Maybe these so-called economists have come out and said, well, interest rates are low and they need to go higher. And this is where the average is, inflation's a problem. But suddenly we've seen the opposite play out. Inflation's dying and we've seen interest rates start to cut. And that's given a lot of people the confidence to come into the market and start buying up. And this all plays into this narrative that we're entering the winner's curse. Now, where things could change is when people think that, hey, prices will go up, but inevitably they have to come back down. And according to the 18.6 year cycle, it means prices will fall off by anywhere between 20 and 40%. Now, that's never happened in Australian history. So I know this looks at land prices in the US, but it's never happened in Australia. So what could that actually look like? Well, let's say you did happen to purchase a place for $700,000. And let's say in year one of the winner's curse, which would be 2025, according to this, we could see prices go up by say 15%. So now that property is worth $805,000. But let's assume we have another year of growth, and let's say that happens to be also 15%. That means that property you purchased 2 years ago for $700,000 is now worth $925,000. So we now sit there and say, okay, We've perfectly timed the market because we had this graph to go off, and now we've seen prices where they're at. So yes, it's not sustainable. Affordability is a concern. Maybe inflation comes back. Now we're going to see prices drop. And if they do drop, what's the largest drop we could potentially see? Well, in Australia, if you looked at capital cities and major regional hubs, the highest that you could probably see is about 12 to 15%. And even when we saw interest rates go up by 13 times, Sydney went down by about 7.5%. So something major would have to play out for this to be caused. And even if it did play out and you saw a drop of 10 to 15%, that would still mean the property you purchased today would be worth a lot more than it would be in a couple of years' time if this graph is to play out. The other thing that you need to take into consideration is what happens if you have no exposure to the market. Imagine not having a property and saying, no, I'm not buying because this is the worst time to buy. Okay, fair enough, because there's evidence to maybe suggest that is the case. The next 2 years play out, and because these are averages, what happens if we see the correction happen in 6 years, not 2 years? Or what happens if we see the correction from next month? These are the sort of risks that you need to take into account when you're building out your own strategy. Now, I'll have a link to my blog, which actually talks about the strategies of how to navigate the 18.6 year cycle. For anyone that wants to sit there and actually just read instead of me talking about it, I'm going to leave a link in the description box below to the blog as well. As Benjamin Cohen says, all models are wrong, but some are useful. And I think in this case, yes, it would be perfect if it all played out and I could decide to sell at the top and then get back into the market. But you need to factor in a few things. The Australian housing market is very resilient, and yes, we are entering into a period where affordability is at the rock bottom. We're going to need to see something change. But with such a supply crunch and liquidity coming back into the market, I just don't think that we're going to simply see this market completely drop off where we're expecting 20, 30, and 40% drops. In the last 12 years of investing, I've heard this every single year, and it's peak fear. I think over time, we're just going to see prices continue higher and higher and higher, and I know that some people don't want to hear that. It's not because the properties are worth so much more, it's just that the dollar is losing its value. And this is something that's very important to keep in mind. Whether you invest into real estate to make money, whether it's to just buy your own home, whether it's to go out there, take on more debt, or whether it's to go and invest into, say, something like Bitcoin, you need to protect your wealth. And right now, a lot of Australians look at investing in real estate because that's the best form of protecting their wealth, because they're taking on debt in today's dollars and they can pay it off in tomorrow's dollars. And that's been such a unique way to build wealth. You have other instruments now available like Bitcoin, and you've had gold for a long time. You may look at alternatives as well. The reason I like real estate is because I can get that leverage. And if we do see heaps of price growth over the next couple of years, I can simply take out that equity, I can put it to the side and have it sit in an offset account and not have to use it. If we see a market crash or we see the market continue higher, you need to have a plan for both scenarios. And if you need help with any of that, definitely go ahead, book in a call with our team, because this is the sort of stuff we're preparing our clients for over the next 5 to 10 years, because realistically, you're not buying property for 2 years. You're buying property so it's a hedge against inflation, as well as that long-term retirement. And you're looking at holding property for the next 15 to 25 years at a minimum. If you're someone that's looking at property for a short-term flip for 18 months, then I'm not sure why you're listening to this channel. I hope you guys have enjoyed this video. If you have, let me know in the comments down below what you enjoy, what you think is actually going to play out, and I'll catch you guys in the next one. Thanks, guys.